My greetings to all the people who are watching this. Today we are going to start with a new series called Finance for Everyone. Thanks to Government of India who has introduced the new education policy in which the ability enhancement, skill enhancement courses and most articulated syllabi has been introduced, owing to which such subjects become vital and the students can be benefited because the entire scheme of new education policy is student centric and we want students to learn not only the cognitive skills but psychomotor domain, affective skills, etc. So in this backdrop, we have selected in this series the curriculum of Finance for Everyone. So let me start with the first lecture series in finance. So this particular module will lead to the introduction part of what finance is all about. So let us start with the basic idea of finance. Finance has a deep impact on both the corporate and the individual investors. In much talk about topic of finance, each and everyone talks about how to raise the finance, how to multiply the finance, how to manage the money, etc. Because there are so many business dynamic conditions which are surrounding and they are to be incorporated in the financial policy of a corporate, and unless and until we do and understand the different dynamics of the finance, we will not be successful in terms of increasing and multiply our profits. So in the current era, finance may be defined as an art of raising and managing the money. And in other words, we can say it's an investment of asset under the condition of risk and uncertainty. Definitely you've selected a kind of a business and you have put together all the money as capital investment into that particular business. But you don't know what kind of scenario it is going to be in future, because we are all surrounded by different types of risk when we put money. And there is a different uncertainties involved, whether the product will be liked by the people, whether the money will be multiplied, whether there will be a recession in the economy, in the international economy. So we are not only limited to the national economy research and risk and uncertainty factors, but it is also about the global aspects which are also vital when you start doing the investments. So in a holistic way, we have to analyze the investment part of it so that we are able to achieve our financial objectives. Finance, when you talk about, is not limited to the big companies or the government agencies only. Rather, every individual needs to manage its daily finance, that is, it needs to control their expenses and must have the sources of money at the time of emergency in order to have a secure future. Now, basically, when you have to understand this particular concept of contingencies in order to understand the emergencies, in order to optimize the funds, you never know what is going to happen in future. You have made an investment today and you don't know what is going to be happening tomorrow. Probably the concept which you have introduced, the conceptualization of the entire financial plan can be multiplied by 0, like if you are not keeping into considerations the expenses, the unexpected expenses, the contingencies which can happen in future, and of course the emergencies when you talk about. So in order to have a secure financial plan, you have to keep into consideration the control of the expenses, the ad hoc expenses, the emergent expenses, and the emergency which can happen anytime for the rainy days also. In order to secure your future, all these factors have to be seen in the same frame. Now let me give a concept of what is finance. Finance is the use of economics principles to make a rational decisions involving allocation of resources. Finance involves the investment of money under the uncertain environment. Investors invest their surplus funds in various financial assets for their predetermined objectives. Now, keeping the definition very simple, what is the meaning and the core aspects of finance? What do we mean by finance? Finance is basically keeping into consideration at the center, at the nucleus, the right kind of decisions which are involving the money part, the allocation of your hard-earned resources. And of course, if we are able to do that, that means we are able to understand the different dynamics of finance. The money does not grow if it is not invested. The money will grow when you do the investment. And the principles of finance is all about investment. And that too, keeping into considerations the different uncertainties surrounding, keeping into considerations the various factors surrounding, not only about the national factors, but also of the international dynamic environment also. So the investors, they invest their surplus funds in the various assets for their predetermined objectives. So once you start thinking about the finance, about your investment plans, the first and the foremost thing that you have to talk about is a predetermined objective. That is, you have to set your objectives in advance, and then probably you have to collect the finance, that how the finances are going to be raised, how they are going to be managed, what kind of policies are to be introduced, and eventually you will be a successful investment plan. So finance allow an individual, businesses and the governments to raise the funds for their operations. Now, coming on to the framework of finance, we have talked about what finance is, the different definitional aspects, what factors are to be considered when you talk about a right kind of investment in finance. So, the framework of the finance talks about two things. First, the sources of raising funds. Second, once you have raised the sources, where to invest. And of course, on the basis of that, you will take a decision which is relating to investments. So they look very simple, but the rationality of taking your financial decisions is of paramount importance. Like if you are into a medium scale business, if you are into a small scale business, and if you are into a large scale business, the sources of raising of the funds would be different. And once you take a selection of which source to be raised, then of course it makes sense after you have collected the funds, because no lunch is free. Once you have raised the funds, there is a cost involved, because the people who are giving you the money, they will expect something in return, which is called as the interest. And probably the people will be only able to or give their consent in giving the money from wherever sources you are asking from. They would see what is the return, whether it is viable to give the money in order to equate the cost of raising funds and the returns what they will earn. So there's a lot of discussion which they will go into. There are a lot of dynamics which they will see, and of course they will lift the veil and try to read between the lines when you talk about the sources of raising of funds. So once you are able to take a rational decisions on the sources and the raising of the funds, the next is where to invest funds. So investment decisions are also very, very important to be seen. There are some frameworks, there are some principles, there are some dynamics which have to be kept into considerations, and then only the investment funds are being taken into account. Then eventually the cost benefit analysis, from where the funds are coming, for how long they are coming, how the money has to be raised, and then where the funds need to be invested. Then eventually you have to take a decision of investments. So this is what we call it as a framework of finance. Now coming on to finance and its relation to the other fields. Finance is related to economics. Financial accounting is also related to finance. Mathematics is a very important field which is also related to finance. Probability theory, whether we will have a success or a failure, is 100% related to finance. The statistical theory, which is a probabilistic theory, the psychology behind is also very, very important part and the field which is related to finance. So we can see here on this particular screen that it is like an intermingled thing. Finance is not at all a standalone thing. There are so many economic principles which are related to finance, which we have to scan, which we have to analyze in order to have the rational decisions of financial decision making. Similarly, the financial accounting, the mathematic part, the probability theory, the probability of theory of success and failure, the statistical theory of assumptions, etc., and the psychology is a major part of the field which are related to finance. When you talk about a psychology, some persons are risk takers, whereas some persons are risk averters. So all these risk factors who are taking into consideration the risk and who are not taking the factors into considerations, the psychology behind investment differs from an individual to an individual. But of course, these fields are not exhaustives, what is mentioned on the screen, but they are primarily the different types of fields which have a very important significance on the financial decisions making. Now coming on to the different types of finance. The first is your business finance. It's concerned raising money by the business entity. The business use finance for their daily activities and further operational activities. And business also uses the finance for their expansion of business. So this is a very important concept for the students who are studying finance for everyone to increase their financial literacy level, because they have to understand the basic nuances of financial literacy. So owing to this, the most important factor what they have to see and analyze and understand is about the finances which are related to business, or we call it as a business finance. Like you have to be very concerned about the sources from where the money is coming. There are certain sources of money which are cheaper. There are certain sources of money which are costlier. So you have to see the factors behind it, the cost behind raising the funds, and of course, once you are able to raise the money, then you have to be very particular about categorical aspects which you have to keep in mind, that the provisioning of the money which you have to keep in your mind, that this is the amount of money which we need for the daily activities, and this is the type of money which we will be straight away categorizing for our operations. And of course, nobody wants to be at a still level. They want to elevate to a bigger level. They want to raise their level of activities. They want to increase the scale of activities. So owing to this, we need to expand the business. So business also uses the finance for the expansion of their business. So this was all about the business finance. The second type of finance, which is very important to be understood about, is a public finance. Now, public finance is concerned about the raising money by the government. The main aim of public finance is to raise funds for the government projects. Now see, when you talk about the public finance, we talk about the huge money, the giant projects, and the public finances principles are entirely different at a different perspective, spectrum and paradigm, because here the level of money what you need is huge, because the government projects are mainly, they are helping the public at large. So how the money it is to be raised by the government, and what is the purpose of raising of the money, and what are the nuances of the government projects, they are at the center when you talk about raising of the public finance. The third type of finance is a private finance. We have talked about the earlier two types of finance, which was one, the business finance, for which the business entity raises the money, for their entire operations and the operationals aspects, for their daily activities, and of course for expansion activities, because nobody wants to be at the strict level, the same level from where they optimized and started. They always want to increase their level. The second type of finance, which we have already talked about, is a public finance, which is concerned by the government raising money, right? And the main aim of the public finance is to raise the funds for the government projects. Now we are going to discuss the private finance. It's concerned raising money by the private entities such as business, firms, or individual investors. It focuses on handling the personal finance. So, when you talk about the public finance, the government finance and the private finance, there are some kind of different aspects which are at the center and the nucleus, or when you take a decision relating to all these factors. Definitely for the private finance, they are mainly for an individual part, an individual businessman, individual investments, etc. So the focus nucleus is entirely different for the different types of finance. Then we have the next type of finance, which is called a direct finance. It's concerned raising money where the borrowers borrow the funds directly from the financial market. There is no involvement of any financial intermediary, that is a third party service. The name suggested as direct means there is no interference, no intermediation from any party. The person who wants the money, they can just go to the financial market and raise the money directly. And that is why we call it as a definition aspects of the direct finance, that it is concerned by raising the money directly from the borrowers from the financial market directly. There is absolutely no role of the intermediary in this type of a finance. Now let me illustrate and explain the same concept by an example. Let supposedly X, Y and Z company want to raise the money directly from the investors. The company may issue the shares or the bonds to raise the money. The company will pay a dividend or interest to the investors against the money raised. So let us see by this particular aspects. The first is your company. There are investors. There is a company raise money, and of course the company has to pay the interest to the people who have given the finances to the company, and of course the dividend part of it, right? So all these things are of basic financial knowledge which everyone should understand. We have already talked about the direct finance. Let us now understand the concept of what is an indirect finance. It's concerned raising money with the help of any financial intermediary, that is a third party services. In this method, the concept of interest arises. Financial intermediary raise the money from the lender against an interest rate and lends the money to a borrower. So we have to have an understanding about what is an indirect finance. That is, the person who needs the money is not directly getting the money from the financial market. There is an in-between person who is called as a financial intermediary. So in terms of raising of the money through an indirect finance, the role of intermediary or the third party services is primarily very, very important. So in this method, the concept of interest arises. Of course, nobody is going to give you the money free of cost. They will charge the interest rate. So the financial intermediaries, they raise the money from the lender against an interest rate and then lends the money to a borrower. So that means an intermediary person is one who connects the lender and the borrower with a cost which is called as interest rates. So again, let me give you an illustration relating to this particular concept of indirect finance. Let supposedly XYZ company want to raise a money from a bank. So here bank is a financial intermediary. The company raise a loan against a rate of interest, let's say at the rate of 12% per annum. It means company needs to pay 12% per annum as interest to the bank. The bank raise money from their depositors. The bank also pay interest, let's say at the rate of 4% per annum to their depositors, and the difference between the rate of interest from the lender and the depositor is the net income of the bank. So it is also called as a spread. Now in the previous example, the bank provide loan against a rate of interest at the rate of 12% per annum and pay the interest rate at the rate of 4% per annum to their depositors. So the spread will be 8%, that is 12% dash 4%. So here when you talk about a company, we talk about the company raise the loan, they pay against the loan to the bank, and the bank gives the money to the depositors of the bank, and the money is deposited by the depositors to the bank, and the bank pay interest against their deposits. So this is how the concept of finance and the financial transactions takes place. Now we have a concept of long-term finance. It's type of finance required for more than 5 years. Let's supposedly 10 years, 15 years, 20 years or more depending upon the business. Such type of finance is used for purchasing of fixed assets like a land, machinery, building, etc. So as the name suggests, the duration for which the money is required is longer, and the amount also which is required is also substantial because you need to purchase the fixed assets, which includes the land, building and machinery. Now what are the sources of the long-term finance? Let us have a look on this. The first source when you talk about the long-term finance is the equity shares, preference shares, venture funds, debentures, bonds, long-term loans from the banks. Then we have a medium-term finance. It's type of finance required for more than 3 and less than 5 years. So the span and the spread is 3 to 5 years. Such type of finance is normally used for deferred revenue expense, which is to be written off within 3 to 5 years. Advertising expenses is an example of deferred revenue expense. Now coming on to the sources of medium-term finance. The first is the preference shares, the second is leasing, the third is hire purchase financing, the fourth is debenture bonds, and the last is medium-term loans from the banks. So these are the 5 types of the medium-term finance which we are talking about. And coming on to the next, that is the short-term finance. It's a type of finance required for business for their daily activities. It's normally required for less than 1 year. Such type of finance is normally used for the current assets like inventory, finished goods, etc. It also known as the working capital finance. So we have talked about the different types of finance in which we covered the short term, the long term, the different types of long terms like equity, preference, venture, debenture and the long term loans from the bank. The medium term, the span is less than 3 to 5 years, and the advertising expense is a live example of a deferred revenue expense. Then we talked about the medium term finance. The sources could be preference shares, leasing, hire purchase, debentures, the medium term loans from the bank, and the short term finance is basically the requirement is less than 1 year, which is also called as a working capital finance. Let us now discuss the sources of short-term finance, out of which the first is the creditors, advances received from the customers, the bill discounting, and the short-term loans from the banks. Now, these are the areas of finance: capital market and capital market theory, financial market and investment management. The capital market and the capital market theory. It focuses on the analysis of financial systems, interest rate and pricing of the financial assets. The financial system includes the financial markets, intermediaries, and the regulators. The capital market theory helps the investors in selecting the appropriate financial assets.